What if I told you that the most powerful force shaping wealth in the modern world wasn't created by markets, governments, or corporations, but by institutions originally designed to protect us from financial chaos? What if the very system meant to prevent crises has, over centuries, evolved into a mechanism that redistributes wealth unevenly, not through conspiracy, but through policy, structure, and historical momentum? Welcome back to Historic Finance Lab, where we break down the hidden architecture of global finance, the forces behind prosperity and collapse, and the patterns history leaves behind for those willing to look closely. Today, we're not painting central banks as villains or heroes. We're examining them as systems that shape outcomes, systems that create stability but also side effects. By the end of this video, you'll understand why central banks became the most influential institutions in modern economic history, how their decisions ripple through society, and why their tools shape wealth distribution more powerfully than most people realize. But keep this question in mind. If modern central banking was supposed to eliminate economic chaos, why do cycles of boom and bust keep returning? The answer isn't simple, and it isn't hidden. It's structural. And it begins much earlier than most people think. In 1694, the Bank of England was founded with a revolutionary idea. Government debt could support the money supply. This wasn't money created from nothing. Early banknotes were still tied to precious metals, and you could still exchange them, but something fundamental had changed. Money and government borrowing were now linked. From that moment forward, sovereign debt and monetary systems grew together, like two vines wrapped around the same tree. For more than a century, central banks were not economic managers. They existed to stabilize government finances, manage war funding, maintain payment systems, and occasionally act as lenders of last resort when panic struck. They didn't fine-tune economies. They didn't target growth or employment. Their role was limited, and their footprint was small. But as economies industrialized and financial systems expanded, crises became larger and more dangerous. The 19th century saw repeated banking panics across Europe and the United States. Each collapse revealed the same weakness. Private banking systems couldn't stabilize themselves, and governments lacked the tools to respond quickly enough. That realization led to a new phase. In 1913, the United States created the Federal Reserve, marking the beginning of modern central banking. Similar institutions spread globally. Their mission was clear: prevent financial collapse, provide liquidity during crises, and stabilize the economy. They were the fire departments for a world increasingly prone to financial blazes. After World War II, the world adopted the Bretton Woods system. Currencies were tied to the US dollar and the dollar was tied to gold. This structure limited money creation, reduced speculation, and delivered decades of strong growth and falling inequality. For a time, the system worked remarkably well, but it carried a built-in flaw. Governments needed flexibility to manage their economies, while the gold link demanded restraint. It was like trying to drive a race car with the parking brake partially engaged. As global trade expanded and government spending increased, pressure built. By the late 1960s, the system was no longer sustainable. In 1971, the United States ended gold convertibility. The world entered the era of fiat money. Currencies now floated freely, and central banks gained a level of influence they had never held before. With no gold constraint, interest rates became the primary tool of economic management, the main lever to speed up or slow down the entire global economy. That power was tested almost immediately. In the 1970s, inflation surged across developed economies. To restore credibility, central banks raised rates dramatically in the early 1980s. Inflation was crushed, but at a cost. Unemployment rose. Small businesses struggled. Debt burdens increased. And asset values shifted in ways that favored those who already owned capital. This wasn't a secret plan, it was a trade-off. Stability came with side effects. As inflation fell, rates declined over the following decades. Credit expanded, financial markets grew, housing boomed, stock markets surged. Economic growth became increasingly tied to asset values rather than wages or productivity. This transformation is known as financialization. Central banks didn't cause it alone. Deregulation, globalization, demographics, and technology all played major roles. But interest rate policy acted as an amplifier. Cheap credit rewarded asset ownership. Those without assets fell behind. By the early 2000s, the global economy had become highly leveraged. Growth depended on borrowing. And in 2008, the system cracked. When the global financial system nearly collapsed, central banks acted aggressively. They cut rates to zero. They provided emergency liquidity. They launched quantitative easing, purchasing financial assets to stabilize markets. These actions prevented a deeper collapse, a second Great Depression. But they also changed the economic landscape forever. Asset prices surged. Stocks, bonds, and real estate recovered quickly, and then some. Wages did not. Savings earned almost nothing. Debt became essential for participation in the economy. Once again, stability came with uneven outcomes. The divide between asset owners and wage earners grew wider. The pandemic shock of 2020 pushed the system even further. Governments spent massively. Central banks expanded their balance sheets at an unprecedented speed. A depression was avoided, but inflation returned. By 2022 and 2023, rates rose rapidly to contain it, placing new pressure on households, businesses, and markets that had grown accustomed to cheap money. Through every phase, the pattern remained consistent. Central banks respond to crises to preserve stability. Their tools work, but they reshape wealth in the process. Interest rates determine the cost of money. Liquidity determines which markets survive stress. And expectations determine how investors behave before a policy even changes. These mechanisms don't require malicious intent to create inequality. They simply reflect how modern financial systems operate. The rules of the game favor certain players. Today, central banking stands at a crossroads. Debt levels are historically high. Populations are aging. Productivity growth is slowing. Geopolitics are fragmenting global trade. And digital currencies are emerging. The tools that once created stability now face serious limits. The system isn't collapsing, but it is strained. Understanding this matters because wealth today is shaped less by effort alone and more by your proximity to assets and your access to credit. Monetary policy doesn't decide outcomes directly, but it tilts the playing field. So remember three things. First, wealth distribution in the modern world is heavily influenced by policy, not just markets. Second, asset ownership matters more than ever in a credit-driven system. And third, any financial truth that lacks historical grounding should be questioned, especially in an era of unprecedented monetary experimentation. The next economic shift is coming. It will look different from the last one. But the forces behind it are already in motion. If you want to understand those forces before they reshape the world again, subscribe to Historic Finance Lab, because once you see how the system works, it becomes much harder to be blindsided by it. Your financial future begins with understanding the machinery behind the curtain. And now, you've seen it.